If you've ever found yourself scratching your head, wondering if you should pay off that credit card, dive into the stock market, or maybe stash it all in a savings account, there's a way to navigate this maze. The key is not just saving money, but knowing the ideal order to invest it. It's about finding a balance between reducing debt and growing your wealth. I'm Will, and I teach people about investing, personal finance, and money. I've walked the path you seek. And today I have several businesses and investments that provide me income every single month, meaning I never have to work another day in my life. If you plan on becoming financially free, be sure to subscribe to the channel and hit the like button if you find this video valuable. So let's discover the ideal order to invest your money. The first thing you need to invest money into isn't stocks or bonds. It's something way simpler, but super important: your emergency fund. This is your financial safety net, for those just-in-case moments in life. Maybe your car decides to break down or your fridge stops working. This fund is the cash you keep on standby to handle these unexpected surprises. Now, how much should you stash away? Aim for about 3 to 6 months of your regular living costs. It's like building a little bridge of money that can carry you over rough waters, like if you're switching jobs or dealing with unforeseen expenses. The best part? This fund helps you steer clear of debt or dipping into your other investments when life throws a curveball. And if you end up using this emergency cash, refill it before moving on to other investment steps. The next thing you need to invest in after setting up your emergency fund is your 401k. In the U.S., lots of companies offer a 401k match. Think of it like a thank you gift from your employer for saving for your future. Here's how it works. You put some of your paycheck into your 401k, and your company matches it up to a certain point. It's basically free money for your retirement. Let's say you earn $40,000 a year and your company matches 5% of your income. If you put in 5%, or $2,000 over the year, your company will add another $2,000. So every $50 you save turns into $100 thanks to your employer. That's a 100% return right off the bat. Plus, this money goes into your 401k before taxes, so you're also saving on taxes now. You'll only pay taxes on it when you withdraw it, which could be 30 years down the road. This way, you're not just getting a 100% return up front, but your money also grows tax-free until retirement. It's a win-win. So, after your emergency fund, maxing out your 401k match is the next smart move. Now, for the third step, we're going to tackle something a bit different: high-interest credit card debt. Think of high-interest debt like a leak in your financial boat. You can keep pouring water out, aka earning money, but if you don't plug that leak, you're not going to get very far. Paying off this kind of debt is crucial because the interest rates are usually way higher than what you can earn through investing. You might be tempted to jump into investing in stocks or starting a taxable brokerage account, but if you've got credit card debt with high interest, you want to deal with that first. Why? Because paying off this debt is like giving yourself a guaranteed return. Every dollar you don't have to pay in interest is a dollar in your pocket. Paying high interest is like feeding the bank, not your future. You're essentially paying them big bucks for borrowing their money. By clearing this debt, you're not just saving on interest, you're freeing up more of your money to work for you in the future. So once you've got your emergency fund and you're getting that 100% return on your 401k, your next best move is to zap that high-interest credit card debt. Next step: debts with lower interest. Think car loans, money you might owe to family or friends, or any personal loans you've taken out. While these might not be as urgent as high-interest credit card debt, they're still important. Why? Because being debt-free is a big part of getting ready to invest. You might be itching to jump into the stock market or other investments, but if you're still in debt, it's like trying to run a race with a backpack full of rocks. You're not really free to move as you want. Being in debt means your money is already spoken for. It's going towards paying off what you owe, not building your future. Getting out of debt might mean you need to tighten your belt for a while, maybe cut back on some luxuries or find ways to boost your income. It's all about making sure that when you do start investing, you're doing it with money that's truly yours, not just rotating through your debts. So think of this step as clearing the runway. Once you're free of these lower interest debts, you're really ready to take off and start focusing on growing your investments. If you're enjoying this video, go ahead and smash that like button, as it really helps the channel. Thanks. Let's dive into the fifth order, which is all about making the most of your IRA. If you're in a higher income bracket, it's super smart to max out your tax-deferred 401k or traditional IRA before you even think about a taxable brokerage account. Why? Because it's all about tax optimization. When you contribute to these accounts, you're lowering your taxable income now, which is a big plus if you're in a high tax bracket. Plus, your money gets to grow without the tax man taking a bite every year, and you only pay taxes when you withdraw it in retirement. And if you're starting out and you're in a lower tax bracket, consider a Roth 401k or Roth IRA. With these, you pay taxes on your contributions now when your tax rate is lower. Then, when you retire and possibly are in a higher tax bracket, you won't have to pay taxes on withdrawals. It's like paying a small tax bill today to avoid a bigger one in the future. Next up, we're stepping into the world of taxable brokerage accounts. Now, this is your chance to try out those high-risk, high-reward opportunities. Maybe you've got your eye on a hot new stock, or you're curious about other types of investments. This is where you can do that without jeopardizing your essential financial needs. The money you use here shouldn't impact your day-to-day living standards if things don't go as planned. It's also a great place for those with a knack for the market to test out more advanced quantified trading systems. You've got the freedom to experiment, but remember, with great power comes great responsibility. This step is all about balancing the thrill of potential big wins with the wisdom of not putting your financial foundations at risk. So if you've taken care of everything else and you're ready to play in the big leagues of investing, the taxable brokerage account is your next frontier. And last but not least is Health Savings Account, or HSA. HSAs aren't a one-size-fits-all solution, though if you're young, single, and in good health, your money might be more impactful if used in the areas we've already discussed. But if you're part of a big family, a bit older, or in a higher income bracket, a HSA could be a fantastic tool for you. Your contributions to the HSA are tax deductible, meaning they reduce your taxable income. The money in the HSA grows tax deferred, so you don't pay taxes on the growth while it's in the account. And the cherry on top? You can withdraw the money tax-free, as long as it's used for qualified medical expenses. It's a savvy way, especially for those in higher tax brackets, to cover medical costs with pre-tax dollars. This is really just a high-level order to invest your money. Once you've got a solid foundation, you can move into more speculative investments like investing in real estate or setting up a business. The key is really to make sure you don't lose all your money to taxes. So if you're interested in how to keep more of your money, check out this video next on 5 tax-free investments that will help you boost your investing journey.